What's guiding you? What's your North Star right now on your dashboard, the economic data that you're looking at?
So the hard data is backward looking. The surveys can be unreliable, and anyone who's taken a survey recently after having a particular service will know what I'm talking about. People are fed up with them. So I'm not sure about the quality of the soft data and the so-called forward-looking data. For me, what matters more than anything else is the distance between today's policy rate and the longer run equilibrium. It's about 3%. I'm not that interested on the date and the amount of the first rate cut, which seems to be where most people are. The next move is down, where it's either unchanged or down. Basically, it isn't up, and that binary outlook for rates makes it much easier to justify a long position in bonds than it did maybe 3 to 6 months ago.
At the same time, Stephen, if they don't cut rates until December, that's going to surprise the market to the downside. So how do you sort of justify being bullish now when we're already seeing a lot of it already being priced in and people getting ahead of themselves?
Yeah, so we've got a neutral call for this month, and I tell my colleagues, look, if it's so obvious we're going sideways for 6 months and then the yields are going to go down in the second half of the year, what are we waiting for? Because you've got the carry and the coupon in the meantime. In the biggest period, the biggest bear market for bonds was in the period 1961 to 1980. The annualized total return was still positive. It was about 4% a year. Now, that kind of thing happened last year. You ended up with plus 4% on the year. At one stage, you were more than minus 10. But that's kind of how bonds work. So, yeah, I get the idea, Lisa. If they don't cut in 2024 for whatever reason, then the 2-year yield should be nearer to 5, and that could push the 10s nearer to 4.5. But that said, they might cut an awful lot too. So you have to balance those two scenarios.
At the same time, we're getting $162 billion of Treasury auctions this week, I should say, 2-year, 5-year, and 7-year. When do we start to worry about supply, especially as quantitative tightening continues?
You know that we get that question quite a lot, and you probably know where I'm going to come from here. The supply side is just one angle in the whole picture. The demand for bonds today is higher than it was 3 months ago, and that's a paradox because yields at 5%, it seems, were less attractive than yields at 4%. I hope I'm making sense, that there is more demand for bonds today than there was back then. That's because you've got the certainty around the outlook. Rates aren't going up. They're going to be unchanged or down. You couldn't say that for sure 3 months ago. That's why 10-year yields are about 100 basis points less. So there's $5 trillion or so sitting in money markets. Pre-pandemic, it was what? 2.5. So presumably some of that money is now shifting into bonds, or soon will be, because there'll be a huge regret if it stays in money markets and the Fed's cutting.